Hey everyone, and welcome back to the channel. Today, we're diving into something that could seriously level up your investment game: sector ETFs. Ever thought about investing in tech, healthcare, or energy, but didn't know where to start? Well, you're in the right place. So what exactly are sector ETFs? Think of the stock market as a giant pizza. A broad market ETF, like one tracking the S&P 500, is like buying a slice of the whole pizza. A sector ETF, on the other hand, lets you buy a slice of just your favorite topping, like all the pepperoni, or in this case, all the tech stocks. It's a basket of stocks from one specific industry, giving you focused exposure to that part of the economy. There are 11 major sectors in the market. You've got information technology, with popular ETFs like VGT or XLK holding giants like Apple and Microsoft. Then there's healthcare, with ETFs like VHT, and financials, like XLF, which includes big banks. Others include consumer discretionary, communication services, industrials, and energy, just to name a few. Each one captures a different slice of our economy. So how do they work? It's simple. When you buy a share of a sector ETF, you're buying a tiny piece of all the companies held within it. The fund manager does the heavy lifting of buying and selling stocks to match the sector's performance. This gives you instant diversification within that industry, which is much less risky than trying to pick a single winning stock. Now, this is where it gets really interesting. Different sectors perform differently depending on where we are in the economic cycle. For instance, during an economic expansion, sectors like technology and consumer discretionary often do well because people and businesses are spending more. But during a recession, defensive sectors like consumer staples, think food and household goods, and utilities tend to be more stable because people need these things no matter what. By understanding this, you can rotate your investments to potentially capture gains in any economic climate. This strategy is called sector rotation. When you're looking at sector ETFs, you'll find different types. Some are market cap weighted, meaning bigger companies have a bigger impact on the ETF's price. Others might be equal weighted, giving every company in the ETF the same influence. There are also leveraged and inverse ETFs, but be careful. Those are for experienced traders as they carry much higher risk. So how do you pick the right one? First, look at the expense ratio. Lower is better, as it means more of your money is working for you. Second, check the holdings. Do you like the top companies in the ETF? Third, consider the economic outlook. Do you believe a certain sector is poised for growth? For example, if you think renewable energy is the future, an ETF focused on clean energy might be a great choice. Let's talk long-term performance. We looked at historical data, and over the past few decades, technology and healthcare have been standout performers. They've benefited from innovation, an aging population, and global trends. But remember, past performance is not a guarantee of future results. The top-performing sector of one decade is rarely the top performer of the next. Want a sample portfolio idea? This is just for educational purposes, not financial advice. A core satellite approach works well. Your core could be a broad market ETF. Then, you can add satellite positions with sector ETFs. For example, if you're bullish on artificial intelligence, you could add a technology sector ETF to your portfolio to overweight that area. This gives you a solid foundation with the potential for extra growth. That's a wrap on sector ETFs. They're a fantastic tool for adding precision and strategy to your portfolio. If you found this helpful, give this video a thumbs up and don't forget to subscribe for more content to help you become a smarter investor.